Commercial property or residential property, the ongoing debate continues. Today I'm going to talk about commercial property and looking at some of the pros and the cons of investing in commercial property. So this is apt because just last week I've had an offer accepted on a commercial property. So let's look into some of the reasons why you might want to invest in commercial property or have it as part of your overall investment strategy. Now, commercial property, point number one. Let's start with a subject that I love to discuss, and that is tax. Generally speaking, there are a lot of tax benefits associated with investing in commercial property. The first one is, for those of you that are from the buy-to-let world and worried about Section 24, that you're able to offset your interest as an expense irrespective of the entity that owns the commercial property. So you can offset your interest as an expense, whether you own it in your personal name, a limited company, an LLP, so on and so forth. So that's great news for people investing in commercial property. Also, I'm not done on tax. There's a couple more points. Stamp duty is completely different in what we call non-residential stamp duty rates. So as you will know, when you go to buy a property as an additional, as an investment property, you're going to pay 5% additional rate charge now, thanks to changes in the previous budget. And you're going to pay the applicable stamp duty rates, which are based on thresholds, which are also imminently changing. Now, the next aspect of tax in relation to commercial properties is stamp duty land tax. This will always be cheaper in commercial terms than it will be in residential property. So unless, of course, caveat to that is if you've got a specific exemption for your residential property purchase, but generally speaking, resi property is going to have a 5% additional surcharge on top of whatever the stamp duty rates are, whereas the most you will ever pay in commercial property in the highest threshold is 5%. So completely different. To give you an example, if you're buying a property for around £350,000, the stamp duty for residential property is somewhere in the region of £21,500 compared to a non-residential purchase or a commercial property purchase, you're looking at more like £7,000. So that's a difference upfront cost of £14,500. That's a massive chunk of money that is paying for absolutely nothing. So good saving on the front end. That's very, very useful to know. And that's because stamp duty for commercial property is done in a very different threshold. So £0 to £150,000, there is no tax to pay. Any amount between £150,000 and £250,000, there's 2% tax to pay. And everything over £250,000, there's 5% tax to pay. So that's why it works out much cheaper for non-residential or commercial property. Now, what is a non-residential or commercial property? Well, I'll make it really simple. Anything that's not a house. So a lot of people, when you say commercial property, they think of a shop or they think of a restaurant. But actually, a commercial property could be a cemetery. A commercial property could be a strip of land. It could be an airport. It could be anything that is not housing human beings as their primary residence. It could be a hotel. It could be any type of non-residential property. You get the point. So there's actually a lot more commercial property out there than people realize. You could buy a garage and rent out some garages, or you could buy storage containers and rent out storage containers. So of course, naturally we gravitate towards thinking about the high street. And if you are going to think about the high street, my top tip with commercial property is make sure you invest in Amazon proof commercial property. What I mean by that is services. So things like getting haircuts, which at the moment, there's not yet little robots that will come to your house and cut your hair for you, which means we need to physically go to a premises and get our hair cut. Whereas if you go to a shop that's selling items that can one day be replaced by Amazon, that may be a trickier investment. I'm not saying you set up the business, by the way. I'm talking about buying the building that the business operates in. So Amazon proof is my little side note, but let's get back into the whys you might do. We're still on tax, by the way, not past the tax part. So there's two words that I want you to be aware of if you're going to be investing in commercial property, and those words are capital allowances. This is a benefit that is now unique to commercial property. I say it's now unique because once upon a time, for those who've been investing for a long, long time, will remember that you used to be able to maybe claim a little bit against your HMOs, and you used to be able to claim against your service accommodation or short-term lets, which very recently changed. In fact, April this year is completely gone, but now it's purely reserved for residential property. What does that mean? It means you can claim against certain fixtures, fittings, and parts of the building that are in integral to the building itself. So what you can do, and by the way, a lot of people say, oh yeah, I spoke to my accountant about this. Forget about that. This is not something that you speak to your accountant about unless, perchance, which is unlikely, your accountant happens to be a capital allowance specialist. This is something you speak with a capital allowance specialist about. So how this works, capital allowances, let's go through the process and let's talk about what it means in real terms for you. You appoint a capital allowances surveyor. They carry out a capital allowances survey on the building. They assess door handles, light fittings, how much wire's in the wall based on educated assumptions, and they will make a claim based on that material, that stuff that's in the building. And they will make a claim based on their findings. And they will create a report based on their findings. They will give that report to your accountant, who would then offset that against your tax bill, which means you will not pay tax on that amount. Many investors don't know this. In fact, the majority of investors, even in the commercial property space, have never claimed the capital allowances that are available to them. That's like leaving money on the table. Imagine this. Imagine having £100,000 and leaving it on the table and doing nothing with it, so that it got old and dusty. That's what you're doing when you're not claiming your capital allowances. So what do you need to know? Firstly, most people have never claimed them. So most of the time, there are capital allowances available to claim, but you can only claim capital allowances against the building once, which means part of your research when you're buying a commercial property should be to elegantly discover whether or not capital allowances have in fact been claimed against the building. And that's something that between your solicitor and your capital allowance specialist and a CPSE form, which is part of your initial inquiries, you'll be able to do. Nowadays, you need to get your seller to transfer over the right to claim those capital allowances through something called a Section 198 election, which is a form that they fill in and transfers over the right to claim capital allowances. And then finally, you get the report done. You generally pay a percentage of the saving, so it's all relative to how much you actually saved, and you give the report to your accountant, who will offset that against your expenses. And I'll give you an example. I'm buying a building. It's about £325,000. I'm expecting there's going to be capital allowances in the region of about £140,000. So that means that the revenue generated by that property, the first £140,000 of it, I'm going to say this slowly because I really want you to hear what I'm saying, is entirely tax-free. So £140,000 entirely tax-free, which if I didn't know to do that, and by the way, quick reminder, your accountant probably doesn't know that you can do that, then I would not be able to claim that and I would miss out on that. Now, they're not always available, so don't make decisions based on whether there are or aren't capital allowances available, but it's worth knowing that when they are available, and they most often are, that you've bought it properly so you can actually claim them, that you do actually claim them, and that you claim the maximum amount. So you're welcome on that one, by the way. Game changing, and that's one of the big things that can be a massive benefit in the commercial property space. The last one on tax, I'm going to throw another one in that I wasn't originally going to throw in, but it's just popped into my head, is that you can actually buy commercial property through your pension. Of course, if you've got a limited company, you're generating big profits, you might use a pension to keep your corporation tax down, which means you might be paying into a SIP or a SAS up to your £60,000 a year limit. Now, as you accrue money inside that pension, you can't use that to invest in residential property, but you can invest in commercial property from your pension. So worth keeping in mind, that might also be another benefit with commercial property and another reason to be looking at or understanding commercial property. So what other reasons might there be for investing in commercial? By the way, I'm going to balance this out. It's not all sunshine and rainbows, but let's cover off some of the other benefits of commercial properties. Longer leases. What would you say if I said, well, you can have a tenant in your property for the next 10 years. You don't have to think about any voids. You're going to get paid. That's the end of it. You can just set it and forget it in the purest sense of the word. Generally speaking, you get 5-year leases, 10-year leases, 15, 25-year leases. So commercial property people tend to take the building for a lot longer. Most people don't set up like a tenant would and say, well, I want to take a 6-month or a 12-month tenancy. And that's not really the foundation for building a good business. You know, at minimum, most people tend to want is maybe 3 years. And obviously you can decide what you want if you've got the right property when you're setting that agreement with your tenant as well. So long-term tenants that are staying in the property. And if you're going for an FRI, which is a full repairing and insuring lease, then that also means that your tenant is responsible. So again, another benefit here, if you've got a residential property, maybe you've been in buy-to-let for a while, you will know that when that boiler breaks as the landlord in a residential property, you have a legal obligation to go and get that boiler fixed. You're going to be sending your people around, footing the bill. You know, if there's a leak in the roof, you're going to have to get that sorted. However, with commercial property on an FRI lease, a full repairing and insuring lease, that obligation now falls onto the tenant. So they now have a responsibility to fix their own boiler. They now have a responsibility to take care of the roof. So this is a big difference between commercial property and residential property, provided you've got the right contracts and agreements in place. And that can be game changing again for somebody who wants to be hands off and wants predictable income. So that's another strong reason that FRI, full repairing and insuring. It's worth noting that also means the tenant is responsible for insuring the building as well, which means they have to take out an insurance. What a lot of people will do, a lot of landlords will do in the commercial space, is they will get the insurance and charge that back to their tenants, because that way you can make sure you've got the correct level of cover. Because let's face it, if you get them to get their own insurance, call me cynical, they're probably not going to get the best cover. They're probably just going to get the cheapest one that's going to save them the most money. So full repair and insuring, they repair the building, they insure the building, but I recommend that you arrange for that insurance and charge it back to them. That's another reason that you might want to go down or add in commercial property into your investment strategy. The next one then is the yields, the big term that you hear in property. How much money, cash flow does it actually generate? Now, generally speaking, commercial property will cash flow higher than your standard buy-to-let residential property. A house that's 200 grand and maybe it's generating £10,000 a year in rent, which isn't bad, by the way. That's a 5% yield. That's pretty decent. But if I've got a commercial property, I might expect that I'm going to make a bit more. Maybe I'm going to make 8% yield, all the way up to 10% yield in some areas. So that could be £16,000 in rent. That's a fair difference on your bottom line. So generally speaking, you're getting a higher return for your property. But let's balance this out, because it's starting to sound super exciting investing in commercial property, but we need to add a little dose of reality in here as well. Yes, you're going to get a higher rent, but why do you get a higher rent? Well, part of the reason that you get a higher rent is because the properties don't go up as much. So what that means is you've got a building which is not benefiting from the same level of capital appreciation as a residential property. This is why, by the way, when you take a commercial property and convert it into a resi, you're often going to see a big uplift in the value, because the price per square foot for residential, generally speaking, is higher than the price per square foot of commercial property. So you're going to not benefit from the same sort of growth. I wouldn't expect to benefit from the same sort of growth from a commercial property, and that means that relatively the rent is higher, hence the yield is higher. So that's something to keep in mind if part of your strategy revolves around building a growing asset base over time. That's a potential consideration. Another potential consideration, yeah, you're getting higher rents. How much is your mortgage? You know, if I go and get a buy-to-let today in today's market, depending on when you're watching this video, I could get a buy-to-let property on, let's say, 5% interest rate. That's not bad. I'm landing a commercial mortgage right now, and it's 8% interest rate, and that's actually a decent deal. So it's more interest, which means more expense, which means although I'm getting more rental return, actually you're still squeezing the bottom line a bit. So you have to factor this in when you're doing your calculations. And the real reality is, just to be clear, I don't think you should do one or the other. I think you should probably aim to be doing both. But the big thing you've got to do is take into account what your overall investment strategy is. Now, before I move on to wrapping up, the other thing that springs to mind that you need to be aware of and probably think about is the type of commercial property that you're investing in, and where you think that market's going. We're in a rapidly changing world. The high street is ever changing. Some people say the high street is dead. Maybe you think the high street is dead, but it's certainly changing. And then we're also in a market where, are people working more from home? Do we need as many offices? So if you're moving into those sort of commercial spaces and you don't know what you're doing, risky business. So just make sure you're picking a type of commercial property if you are going down that route, or you think at least is going to stand the test of time. Generally speaking, it takes longer to get commercial tenants in. You can expect when you are actually looking for a tenant to have a longer void. But if you're just doing it as investment, maybe you want to buy a property with a tenant in there. So that's another consideration to have in mind. And selling a commercial property is a little bit different to selling a resi. It's a bit more of a niche market. So you might take a little bit longer to sell a commercial property as well. So if you're looking to get in and out, again, might not be the strategy for you. But again, commercial conversions beyond the scope of this video could be a great way to realize an uplift in those properties. So to round it up, should you do it? Should you not do it? It depends, of course. It always depends. It depends on what your goals are in property. If you are incredibly busy and you have no time to think about property, you're working in your business and you just want to park your money up in something and know it's going to look after itself, then maybe commercial property is a good route for you because you've got your tax benefits and your hands off. You can get your tenant in there for a decade. You can have them looking after, maintaining and repairing the building. So you haven't really got to think about anything. You're just collecting your rent. That really is hands off. And so if you're looking for totally hands off, extended periods of time, it might well suit you. But again, my personal view is having a balanced portfolio. Then you get the pros of all different strategies. Let me know what you think in the comments. Is commercial property for you, or is it something you want to avoid? By the way, don't be scared of commercial property. It's not that complex. If you know residential property, it's just as easy to know commercial property. So let me know what you think. And by the way, if you like this content, if you find it valuable, useful, and you want to see more of it, then make sure you hit the like and subscribe button. And of course, you are truly welcome.